And so any owner or any investor is looking at, well, what kind of return can I expect on my investments? And that a lot depends on the economy, good or bad. We have all kinds of factors. But there's some things that we can calculate, things that we can evaluate when we look at a company. And I'm going to show you a tool that was shown to me by a friend of mine years ago that I have loved to use and I've loved to teach it, but it has great application. And we're going to go through the mechanics of it first. And then I want to show you how you can use it not to evaluate the past, but to help forecast the future. And that's the most valuable part of this tool for decision making. Okay? And we're going to do that with you. Now, in order to do that, I've got to start by giving you a very simple example. Nothing complicated, pretty simple. You're going to say, well, this is obvious. Well, follow it with me because I want to show you what we'll be doing. I'm going to start a business today, and I'm going to make an investment in my business of $1 in cash. I'm going to open up an account at the bank. I'm going to deposit my dollar, and I'm going to begin to acquire assets. I'm going to get my business started. And I finally made it through the first year, and I'd like to see how good a return did I get on my $1 investment. And so this is what I see in my financials at the end of the year. My revenues were $3. Minus only my operating expenses. In other words, these are the direct expenses related to the purpose of my business to start with. This is not miscellaneous stuff, the other category that we run into. And my operating expenses, $2.55. So I had a 45 cents operating, and I'm abbreviating here, operating profit. And a lot of times we refer to this as EBIT, the acronym for earnings before interest and tax, because that's about financing and about what the tax rates are. Now, if I were to ask you right now, and you can do this in your head, if your operating profit is 45 cents and you invested $1, what is your rate of return? And you would say, oh, it's 45%. Absolutely. But that 45% is comprised of two separate ratios. And this is the first ratio. What is your operating profit as a percent of revenue? So if you divide this, in other words, if I were to say, well, let's put this on a per dollar basis. This is 100%. 255 divided by 3 is 85%. Then obviously 45 divided by 3 must be 15%. And so what you're looking at in this case is, for every dollar that we sold, what were my operating costs? What was my operating profit before interest and tax? 15%. That's the first ratio that we're going to look at that has to be controlled. But the second ratio we call asset turnover. And that is, if you take your total revenues, which we know was $3, and you divide it by your investment, your invested capital, your assets of $1, asset turnover is in the number of times. For every $1, we turned it 3 times or into $3. And each time we made 15 cents or 15%. And so by multiplying, this gives me that rate of return, 45%. So you can see that there's two things going on. Here's the first one. Management's ability to generate revenue by using assets it invested in. And these assets are net of debt. But the other one is their ability to control their expenses by looking at what is your operating profit out of each dollar that you sold. And when you multiply those together, that gives you your rate of return. So if I want to change this rate of return, I've got to focus on those two particular ratios. So while we're here, let's play with it for just a second. What would happen if I could figure a way to reduce my operating cost from 85 to 84%. Then 84 from 100 would increase this number to 16. And 16 times 3 would be 48%. So a 1 penny reduction in my cost gets multiplied by 3 and becomes 3 pennies and jacks that up to 45%. But on the other side, let's suppose this remains as it originally was at 15%. But my revenues went to $4, and I'm maintaining the same operating percentage profit. Then 4 divided by 1 would be 4. And 4 times 15 would be 60%, not 48. Now, I don't know that you can increase your sales that much, the revenues, but if you can, look at the impact. Now, so my question always when I deal with this is this, which is more powerful, addition and subtraction or multiplication? And obviously, multiplication is. So if I'm in management, my focus primarily, at least the most important part, is generating more revenues. And secondarily, controlling my cost. Because that increase has more power as long as I can keep my cost in the same relationship that they've been per dollar in the past. So we're going to focus on both of those things. And we're going to look at an analysis, a way to take those two ratios, put them together in what's called an ROIC tree,